Thanks to Bruce and Ken for this great conference. It's great to see such a turnout. I know a lot of Wharton alums are here, so I'm glad to be part of that. And I should also say this paper is joint with two Wharton PhD alums, Zhenfeng Yu and Yu Yuan. I should also say I'm particularly pleased to be here in the presence of Harry Markowitz. His work taught us long time ago about the benefits of diversification. In some sense, the perhaps closest thing to a free lunch that financial markets offer is the ability to diversify. And in fact, that led to a extensive, long-standing literature arguing that the only kind of risk you should really get compensated to bear in financial markets is the risk you can't diversify. And in fact, soon after these theories, the CAPM came out, empirical work began looking at the theory, and some of the earliest empirical work was focused right on that question, is risk that one can diversify away compensated in the form of higher average return? And some of the early work, classic work, for example, by Fama Macbeth, concluded that no, the only kind of risk that you're compensated for is the systematic kind, the beta risk, and that sort of idiosyncratic volatility, the unsystematic risk, is not compensated. But there have been some mixed results on this question over the years. A number of studies found a positive relation between idiosyncratic volatility and average return. And in fact, you can sort of generalize the basic portfolio theory and get to a positive relation under certain conditions like limited information and limits to diversification. But somewhat more puzzling evidence is really what's sort of dominated the literature more recently. In fact, Andrew Ng and his co-authors in 2006 in a, I think I was the editor when we published your paper in Journal of Finance. And they were the first to really document a rather puzzling negative relation between average return, average sort of risk-adjusted, factor-adjusted return, and idiosyncratic volatility. And this appears to be a fairly robust finding. Some very recent work by Chen et al. Looks at a variety of issues that have been raised to the robustness, but their conclusion is it's a pretty robust result. And in fact, this morning, Andrew showed us it also shows up in the over-the-counter market as well. So our study's about trying to address this puzzle. There have been proposed explanations, by the way. I've listed some of the prominent ones here, having to do with for example, lower disclosure of negative information could produce higher I-vol, and of course, if it's negative information, produce lower returns. And also been some evidence looking at different segments of the market and to where this relation may or may not occur. For example, high institutional ownership is one segment people have looked at. I'll actually talk a bit later at the end of my talk on institutional ownership. In terms of the other explanations, one of the things that, of course, sort of a rational approach would look for, in some sense, where you try to explain everything based on what kind of risk should be priced, would be that I-vol reflects some kind of exposure to a systematic risk that simply hasn't been fully articulated and defined up to this point. And while we can't really rule that out for sure, I think what you'll conclude, I hope, from our evidence is that while all these explanations may be at work to some degree, we think they're challenged to explain our empirical findings. And let me just give you a brief synopsis of our argument here. There are basically two things that involve deterrence to sort of arbitraging away potential mispricings in the market. One is risk, and we argue that idiosyncratic volatility, and this is not a unique argument to us, others have made it, is higher risk for an arbitrageur. If you have to depart from a benchmark to take sort of an unbalanced position, the non-systematic idiosyncratic risk in those securities represents risk in the sense of that arbitrage activity. And then the other thing that arises with trying to exploit mispricing is that shorting can be more difficult than purchasing. For many investors, many can't do it at all due to various constraints, and even for those who can, they may find it more costly and even riskier, as I'll talk about later. So these two notions of arbitrage risk and arbitrage asymmetry, we believe, combine to explain the IVOL puzzle. The one thing that we should realize is that if there are deterrents to arbitrage, they should hit on both sides of the mispricing spectrum. If some stocks are overpriced and some stocks are underpriced, then among the overpriced stocks, what we should see is that, for example, if idiosyncratic volatility is particularly high, those will be the stocks where there's the greatest deterrent to correcting the overpricing. So more overpricing, i.e. negative returns, should remain. Stocks that are underpriced, well, the stocks that are most volatile and underpriced are also the ones where there's the greatest deterrence to correcting that underpricing. Right? So what we should see is that idiosyncratic volatility should really enter in different directions depending on which side of the mispricing spectrum one's on. Now, as I said, the idiosyncratic volatility puzzle is that there's a negative relation between IVOL and expected return. So this is where the arbitrage asymmetry comes in. If it's tougher to short than go long, then more of the overpricing is going to remain. You've got two things at work. You've got the idiosyncratic volatility deterring arbitrage, and you've also got arbitrage asymmetry with essentially fewer investors willing or able to exploit overpricing due to the impediments due to shorting. Okay. So what should happen here is that even though there's a sort of positive IVOL effect on the underpriced side and a negative one on the overpriced side, when you aggregate everything together, the overpriced side should win due to the arbitrage asymmetry, and you should then get a negative overall relation in the cross-section between idiosyncratic volatility and average return. In order to explore this empirically, we first have to construct some measure that represents mispricing or potential for mispricing, and for that we rely on a fairly extensive literature on return anomalies, and I'll go into more detail on that a bit later, but we basically sort of stratify stocks, rank them on a spectrum from overpriced to underpriced by combining information in these rather well-documented return anomalies. And then what we find is that once we stratify based on this degree of underpricing and overpricing, we indeed observe empirically among the overpriced stocks a negative relation between IVOL and average return, and among the underpriced stocks a positive one. But among the overpriced stocks, the negative IVOL effect is stronger than the positive relation among the underpriced, and therefore we get an overall negative effect in the cross-section. Okay. The other thing I'll show you involves looking at variation over time. Right? So this mispricing measure that we're going to construct is really just sort of an ordinal ranking. At any one point in time, the stocks that are overpriced based on that ranking are only overpriced relative to the other stocks in the ranking at that point in time. In a gross sense, they may all be underpriced. Or a stock we identify as underpriced in the cross-sectional ranking at a different point in time may still be overpriced. It may just be the least overpriced. So if there's time variation in a mispricing tendency, then we should see that play out in the strength of these IVOL effects For example, when there's more overpricing in general, we would expect the negative eyeball effect among overpriced stocks to be stronger. And when there's less overpricing and more of an underpricing tendency, we would expect the positive eyeball effect among the underpriced stocks to be stronger. Indeed, that's what we're going to find. We're also going to see that this sentiment-related variation is stronger among overpriced stocks. Now, I'll talk about investor sentiment, how we measure that. That's what we use to sort of gauge the overall market-wide tendency for there to be overpricing or underpricing. Some related work to ours is a recent dissertation by another Wharton student, Lucy Jin, who shows that long-short anomaly profits are greater among high I-vol stocks. So if you're interested in going long-short in various anomalies, the gains, a lot of those anomalies are higher among high I-vol stocks. That's more consistent with our framework here. There's also another earlier paper by Cao and Han that finds this change in sign in the I-vol effect depending on over and under pricing. They don't get the asymmetry, and they don't really talk about this at all in the context of the I-vol puzzle, but it is another finding of this change in sign. And there's also a recent paper that looks at what happens when short sale constraints are relaxed. And what we see there on high I-vol stocks is you get negative returns after the short sale constraints are relaxed, consistent with this sort of arbitrage asymmetry, particularly being important among high I-vol stocks. One way to think about the role that I-vol plays in a world where there are potential mispricing and arbitrage asymmetry is just to think of a simple one-period model with some mean variance investors and some noise traders. And the mean variance investors come in two types. There are some that have long-only capital. They can only go long. And then there are some that can go long-short. So L's the amount of long-only capital, B's the amount of long-short capital. And then there are noise traders, where Y will denote the noise trader holding of an asset net of the market supply of the asset. Okay? So basically, the noise traders here are the sources of potential mispricing. And then if you work out an equilibrium, what alphas will be in this world, what you'll find is that for assets that are held by long-only capital, in other words, look at all the assets where they show up in the investors that can go long only. There the alphas depend on idiosyncratic volatility and the noise trader demand, and A is risk aversion. But you see you get deflated there by the total amount of mean variance capital, long only and long short. If you look at assets that are shorted by the long short capital, the alphas on those assets look like the ones above, except notice that you've only got the B in the denominator. So if long-short capital is much less prevalent in the market than long-only capital, and certainly if we look at the institutional money management, that's not a far cry from the data. We can see here that what happens is that the risk or the idiosyncratic volatility in the assets that are presumably the most overpriced, those that would be shorted by the long-short capital, end up with bigger alphas. Why? Well, because there's less capital available to bear the risk in those assets. They can't get spread out across as much capital. So the fact that risk in those assets has to be concentrated in a smaller amount of capital allows for greater mispricing, in this case overpricing, to persist and be uncorrected. You can also think about idiosyncratic volatility's role in influencing risk per se. That is, the previous framework I showed you is where the risk is symmetric between overpriced and underpriced. It's simply the amount of capital willing to bear that risk that differs between the overpriced and underpriced side. But we can also identify reasons why, for a given amount of volatility, the risks that short sellers face are not symmetric with the risks that purchasers face. Bruce and Ken talked about margin call risk earlier. We talked about leverage. Well, if you're short, you actually face a greater risk of a margin call for a given amount of volatility. As they explained, that this is often called noise trader risk, that you can essentially take a position in let's say in an overpriced stock, go short, and it could well be overpriced, but it could get more overpriced and necessitate a margin call and even closing a position. In fact, there's some empirical evidence, a paper we cite, recent paper we cite that points to that activity. Also, there's sort of a tail risk effect that comes from positive skewness in multi-period returns that hits shorts differently than long positions. And of course, there's also the risk of short squeezes, which doesn't happen very often, but there have been some dramatic historical episodes. So this point about margin call. So imagine that you are subject to a margin call when you fall below some maintenance requirement. How's margin computed? Well, as you know, it's the equity you have in your position divided by the position size. Imagine you have a short seller and a purchaser that both begin with identical equity and position sizes with 50% margin. Okay? And then they'll get a margin call if they drop below some maintenance. Okay? So think about equal adverse percentage price changes. What do they produce? Well, they produce equal losses of equity for the short and the purchaser. But if you're short and you have an adverse price move, your position's gone up. Okay? You have a bigger short position you did before. If you're long and you get an adverse price move, your position's gone down. The latter effect sort of helps cushion the effect on your margin, right? So if you're long and you get an adverse price move that decreases your equity, well, it also decreases your position size, right? So it somewhat cushions the effect on your margin. Whereas if you're short, an adverse price move decreases your equity while increasing your position size. So this margin call risk is not symmetric in volatility. It's going to be asymmetric. So if you think of a 25% maintenance, a purchaser would get a margin call if the stock drops 33%, whereas a short gets a margin call if it drops by only 20%. And often this is exacerbated by the fact that the maintenance on shorts is somewhat higher. You might get, for example, a 30% maintenance on a short position. And if that's true, then the short receives a margin call if the price rises by 15%, which is less than half the percentage change required to generate a margin call on the long side. To the extent that this margin call risk deters potential arbitrageurs and limits willingness to take positions, we see that that's asymmetric between longs and shorts. I also mentioned the tail risk, and the point here is simply that, as you know, as you think about a multi-period problem, as you start compounding returns, the holding period return over longer periods becomes skewed in distribution, right? If you're short, that positive skewness in returns translates to sort of tail risk or negative skewness in the profits on a short position. Because, of course, again, as you have an adverse move in a short, your position is increased, right? Which means that any subsequent return is going to be magnified in terms of the dollar consequences. So again, if we think of a short and a long with initially equal positions, and the underlying monthly returns on their strategies are both log normal with the same standard deviation, say 4%, and the same sort of alpha, say 50 basis points, either plus or minus, 50 for the purchaser, minus 50 for the short seller. If you then look at a 12-month horizon, and you take monthly returns, compound them out for 12 months, and look at the 1% value at risk, that's the return such that there's only 1% chance of having a worse outcome. the value at risk is 22% higher for the short than for the long in that case. If this kind of multi-period or tail risk is again a deterrent to arbitrage, and you might think of an arbitrage position being one you have to maintain for a while, this tail risk can again be a sort of asymmetric effect in deterring arbitrage. So we have these various things that idiosyncratic volatility does in different from longs and shorts. One has to do with the amount of capital willing to bear the risk. The other has to do with asymmetric effects on risk itself. Okay, so that's sort of the motivation for why we'd expect this asymmetry. What we next do is try to identify a scale in which we can rank by some measure of mispricing. And for this, we take 11 different return anomalies. These are anomalies in the sense that if you look at, say, the three-factor Fama-French model, they can't explain why these anomalies produce positive long-short spreads. In fact, all these 11 anomalies hold up against a four-factor model, with the fourth factor being momentum. They also hold up against the liquidity factor, the Pastor-Stambaugh liquidity factor. We focus here on this study in the Fama-French three-factor model just because that's the context in which this IVOL puzzle literature has essentially been played out. And I've listed here the various anomalies. I won't go through each one in detail. I think you're probably a group like this familiar with many or all of them. They have been the motivation for a lot of various long-short strategies by many money managers. One thing we do observe is that by averaging these things, you do sort of spread out the average returns more in the sense that if we first take the rankings on each of these 11 anomalies and average the rankings and then sort stocks based on those averaged rankings, if you go long the first decile and short the 10th decile on those rankings, you get about 148 basis points a month. Whereas if you first go anomaly by anomaly and go long short the top and bottom decile, and then average those alphas, those returns, you get only about 86 basis points a month. Essentially what we think is happening here is that averaging the rankings first sort of gives you a somewhat less noisy signal of mispricing. But as I said, the rankings here are just relative, right? There's no way that we can say for sure that decile 1 is definitely underpriced at any one point in time. Idiosyncratic volatility we compute in the usual way. We take the most recent month's daily benchmark adjusted returns using the Fama-French benchmarks. And then what we're going to do is form 25 portfolios initially. We just do a two-way sort. We first sort on this mispricing measure into 5 categories, and then sort on IVOL within each of those 5 categories. So one question some people ask is, what effect does diversification have on this? Because you're not forced to hold just one overpriced stock, you can hold a portfolio of them. What's the idiosyncratic volatility on a portfolio of overpriced stocks and similarly underpriced? The basic point here is that the rankings on individual security IVOL pass through to the portfolio. Now, of course, the portfolio IVOLs are going to be lower due to diversification, but there's nothing funny going on with different degrees of correlation among these different segments. You get the high IVOL portfolios for all the mispricing rankings still having the highest IVOL once you look at portfolio level sorts. As I said earlier, what we would expect to see here is that if the arbitrage risk is important, a negative IVOL effect among the overpriced stocks, but a positive one among the underpriced stocks. And if the arbitrage asymmetry is important, we expect the effect to be stronger among the overpriced stocks, expect a stronger negative effect. This is our most important result. This is the main result of the paper. So if we look here at the relation between idiosyncratic volatility and mispricing, we can see our hypothesis here borne out. So you have The left-hand set of bars there are the most overpriced stocks, and each of the 5 bars in that group represent different levels of idiosyncratic volatility, going from low to high as you go from left to right. So there you can see a very strong negative I-vol effect among the stocks that are identified as the most overpriced. The stocks that are both the most overpriced and the highest I-vol within that group, as you can see, have a monthly alpha of over 2%, about 2.2%. And then you can see as you move across the mispricing spectrum, as you move from left to right to the most underpriced stocks, among the most underpriced stocks, you have a very distinct, significant positive I-vol effect. Again, just like in the negative case, it's monotonic and certainly economically significant as well as statistically significant. It's just not as big as the negative effect on the overpriced side. So here you get, maybe 70 basis points as a positive alpha among the highest I-vol stocks on the underpriced side. In fact, you can see the fairly steady progression from negative to positive in the I-vol effect as you go from the most overpriced to the most underpriced. Now, for those that like t-statistics and the like, there's also a table that displays essentially the same numbers. And here you can see the very significant effects in both directions here. The top row of the table here are the most overpriced stocks, top 20%. And here you see that the highest versus lowest I-vol, high minus low I-vol, 180 basis points a month difference, and t-statistic of -8. Among the most underpriced stocks, you have 57 basis points a month positive difference between high and low I-vol with a t of 3.3. A very significant difference as well between the I-vol effects and the overpriced and underpriced stocks. So you see the asymmetry coming through very clearly there. And the bottom row of the table is the well-known I-vol puzzle. That's just when you aggregate across all stocks, what's the effect of I-vol on the alpha. And here you see that overall effect is about -78 basis points a month. The last table did a conditional sort. We first sort on overpricing and underpricing, and then within each of those groups sort on I-vol. So of course there the breakpoints can be different within each of the first groupings. That makes it a little bit harder to visualize aggregation across the mispricing groups. So we also did an independent sort where we first, you sort independently by mispricing and I-vol, so therefore the breakpoints are the same across all groups, of course. But you can more easily imagine then what happens as you aggregate across the mispricing levels. But you see the same effects showing up there. Very significant negative effect among the most overpriced, significant but less strong positive effect among the underpriced, and again a significant asymmetry with the overpriced being a stronger effect. So as I mentioned earlier, one of the other facets of our study here is to look at variation over time. So if mispricing is playing a role here, if we can identify something that relates to the overall level of mispricing in the market over time, then we should see that play out in our I-vol effect. And what we use here to identify time variation in market-wide mispricing is a measure of investor sentiment that Malcolm Baker and Jeff Wergler constructed, where they take a set of 6 underlying measures and extract a principal component of the 6, and that's the measure of investor sentiment. If you plot it, it looks something like this. You can see it's got a fair amount of persistence to it and a lot of cycles that you can tell the usual stories about the highs and lows here. Baker and Wergler go through this in pretty well-known detail at this point, so I won't stop and do that for you, but that's what we use. Now, Jianfeng and you and I published a paper last year in JFE that showed that this sentiment measure does indeed appear to have a rather significant relation to mispricing. Let me just briefly summarize here with two pictures. So we looked again at these anomalies, and we just looked at how profitable are they in different regimes, high and low sentiment. Here's sort of an overall averaging of these anomalies, and here we're averaging the alphas. So these are profits to going $100 long and $100 short, and the annualized profit to that. The blue is following low sentiment. So here you see, both the long leg and the short leg are profitable, and the long short, of course, is the sum of these profits. Long and short contribute about equally following low sentiment. Now, following high sentiment, what you see most notably is that the short leg of these anomaly strategies is substantially more profitable. In other words, the long-short strategies are much more profitable following high sentiment, and you can see that's virtually all due to the higher profits on the short legs. And this is the average effect across these 11 anomalies, but this effect of sentiment is very pervasive. So here are each of the 11 anomalies individually. The orange bars are the difference between high and low sentiment profits on the short legs. The green bars are the difference between the high and low sentiment profits on the long legs. And you can see that for all 11 anomalies, the short legs of those things are substantially more profitable following high sentiment than low sentiment. Not much happening on the long legs from sentiment. This, by the way, is consistent with the Miller 77 model that Andrew talked about earlier, where the action's really on the short side. It's the inability of the market to correct overpricing. And when there's high investor sentiment, there's just a lot more overpricing. So that's my short synopsis of why we think this investor sentiment measure does proxy for market-wide tendencies to misprice. What we're going to do here is then use this investor sentiment measure to look at time variation in the I-vol effect. And what would we expect? We would expect to see that the negative I-vol effect among overpriced stocks is going to be stronger following high sentiment, right? Because there's a tendency to have things be overpriced in general. That's when this negative I-vol effect among the overpriced stocks should show up more prominently. And similarly, we'd expect a greater positive I-vol effect among underpriced stocks following low sentiment. But again, not as strong. We should expect to see this be a stronger phenomenon among the overpriced stocks due to the arbitrage asymmetry. So here's the other main result in our paper. So the bottom three lines in this plot are I-vol effects on overpriced stocks. The vertical axis is the alpha, the monthly abnormal return, and the horizontal axis is the level of I-vol, going from low to high, left to right. And the blue line is the overall I-vol effect. That's essentially the numbers I showed you earlier. What the red and the green do is they break that overall effect up into, they take the sample and just split it up into high and low sentiment using the Baker-Wurgler index. So this is just ex post, take the half of the months that had the highest sentiment and the other half lowest sentiment. And you can see that indeed the relation between I-vol and alpha is substantially stronger, more strongly negative following high sentiment. That's the green line. The red line is the low sentiment. Of course, it's got to be higher than the blue because the average is the blue. On the underpriced side, remember there we should expect that the positive I-vol effect is strongest following low sentiment, when there's the greatest tendency for underpricing, at least for overpricing. I guess it's chartreuse. This line right here is got the highest positive slope. But again, it's not as strong an effect as the effect on the overpriced side. For those are like tables and T statistics, we've got them also supporting that picture. Basically, you can see here the sort of difference in difference, the high sentiment versus low sentiment, high minus low I vol, substantially stronger among the overpriced stocks when sentiment is high. Also among the most underpriced, it's also the case that this difference is statistically significant. Here, again, we would expect to see the positive I vol effect be stronger following low sentiment. Indeed, that's what we see. And that difference is, again, statistically significant, 73 basis points a month as the difference in difference. Now, this high versus low sentiment classification I just showed you is an ex post classification. You wouldn't be able to do it on the run because you'd have to have the whole sample and then go back and cut it in half, right? So an alternative way of describing this effect that doesn't require that kind of ex post split is simply to do a regression of returns on the level of this sentiment measure. In particular, this regression has as the dependent variable the return on the portfolio. And on the right-hand side here, we have the contemporaneous Fama-French factors as well as the lagged sentiment measure from the previous month. So essentially what you can think of this A plus B times S as being is the alpha, and the B times S part is the extent to which the alpha varies as a function of sentiment. And if you look at the spread between high and low I vol, then you're essentially looking at the I vol effect or the I vol effect spread and to what extent its alpha depends on sentiment. And we would expect to see a negative coefficient on everything here. Just as in the previous table, we had negative values in that last column, and indeed we see that that's the case here for all of the levels of mispricing. Again, the asymmetry kicking in where you get a stronger effect among the most overpriced. Now, one question often arises with investor sentiment is, well, to what extent is this proxying or related to some sort of macroeconomic effect? I think some people mistakenly think that one should just purge this all of macroeconomic effects and that what's left over is what's sentiment. Well, of course, that's kind of silly because there's no reason why sentiment can't be related to the macroeconomy. I mean, when people may be overly optimistic and inclined to overprice things precisely when the economy is doing well, right? So if you would purge out the macro-related effect, you would be purging out all of that macro-related tendency to misprice. Nevertheless, this is a question that people still seem to want to ask. Fortunately, Baker and Wurgler also construct a version of their sentiment index that is purged of macro variables. There's six variables here that are related to macroeconomy, and they remove the variation in their index related to these macro variables. So if we repeat the analysis I just showed using that index purged of macro effects, we again get the same results, significant negative I vol effects related to sentiment, and again, significant asymmetry as well. We also, in addition to those six macro variables that Baker and Wurgler controlled for, add 5 additional variables that previous research has shown related to overall variation in equity risk premia, fixed income variables, as well as some consumption-related variables, consumption and wealth variables. And if we repeat what I just showed you with those extra variables included, so now we're letting in addition to this macro-adjusted sentiment level, including these additional risk premium variables that can also then enter the alpha, we still get negative effects, again, stronger for the overpriced. They're weakened somewhat, suggesting that some of these additional variables may be playing a little bit of a role, but one can't say that's not sentiment related, right? I mean, it could be that these variables are correlated truly with sentiment. And I will remind you that we have the earlier evidence that this sentiment measure, in fact, in that study we used this purge sentiment measure, strongly predicts all of these anomaly profits, especially on the short side. Now, up to now, I've just shown you results that are based on portfolio sorts. And one can also ask, well, what is the function that relates I-vol to expected return? And, of course, we don't have to form portfolios. We can use the cross-section of individual stocks to try to estimate that. We take a rather agnostic view here. Rather than try to specify some parametric relation, like, for example, linear, which we believe probably isn't the right thing, we just fit a piecewise linear relation with lots of pieces. So essentially, it's like a non-parametric approach to fitting the function that relates I-vol, sigma, to the excess return, where M is the relative mispricing. That's the mispricing percentile based on our anomaly ranking. And we do this in a sort of in the spirit of following Macbeth. We fit this cross-sectional relation function each month and then average those functions, which allows us to get an overall estimate as well as a confidence interval on the function. So here's what the thing looks like. And what you see is that the effect of I-vol is much more pronounced at the extremes of the mispricing spectrum. In the middle, it's more flattish. And again, you see the asymmetry coming through with a stronger effect on the overpricing side. So this mispricing measure that goes from 0 to 100 goes from the most underpriced to most overpriced. So essentially, the results one gets by sorting on individual securities and forming portfolios are really reproduced in a non-sorting technique that simply looks at individual stocks as the cross-section. Also, we can take those estimated month-by-month functions and, again, just to go back and split them between the high and low sentiment months. And we see a similar effect, sentiment playing here, that when sentiment is high, we see bigger effects at the extremes than in the middle, right? So if in the middle of our mispricing distribution, there's not much misprice one way or the other, then sentiment shouldn't have as big a role there. So we think the fact that not only does sentiment play a role in the level, but more so at the ends of the mispricing distributions is also consistent with our interpreting this as a mispricing. One robustest thing to do is exclude smaller firms. So one might think, well, this is somehow dominated by the fact we've got small firms in this universe. So what we do is just repeat that very first analysis I showed you in the first figure and table, just start excluding smaller stocks. So we first exclude the bottom 20%, very strong results still. Even if we exclude all but the top 20%, include the bottom 80% of the market cap spectrum, we still get a very significant effect among the overpriced stocks as well as the most underpriced stocks. Not as strong in magnitude, but still there and still significantly asymmetric. So this is not at all a small stock driven phenomenon. Again, do the same sensitivity analysis to the sentiment results. We get the same results there, again, even when you exclude many stocks and just concentrate on the largest ones. And finally, let me just show you some results we just put together using institutional ownership. One thing that can proxy for a short sale impediment effect is just how many institutions own the stock. If it's not owned by many institutions, that can be either because there are constraints or impediments to shorting that stock, particularly costly to short, or a lot of institutions may simply think it's overpriced, and the institutions may be constrained and unwilling or unable to short the stock. So if that's the case, if the proxies for that sort of shorting impediment on willingness, then what we should expect to see is among stocks with low institutional ownership, this I-vol effect we're getting is stronger. So we take data on ownership, sort it into the top 30 and bottom 30% of firms based on this residual institutional ownership, which essentially just controls the effect of market cap on the stocks, because of course there's an obvious correlation there with market cap. And then within each of those ownership segments, we again do the double sort on mispricing and I-vol. And we see, as expected, among the low ownership sample, substantially stronger negative effect among the stocks we identify as most overpriced. And essentially nothing happening on the underpriced. Again, this is what we expect. If it's about the short side, we'd expect to see the institutional ownership having its bite on the overpriced side due to the higher shorting impediment effects on the, or higher arbitrage asymmetry, in essence, being captured by the low ownership sample. So with that, I'll just conclude that we offer an explanation for the negative relation between expected return on I-vol, which combines arbitrage risk and arbitrage asymmetry. The I-vol effect is negative among the overpriced stocks, positive among the underpriced. First of those is stronger, so we get the overall negative effect, and we also get time variation in this effect that's consistent with this mispricing and asymmetry story. Open for questions.
I'm curious, and I apologize, maybe I missed that in one of your analysis, but did you control for the actual level of I-vol? And if you did, how you think that would affect your results? I'm just thinking, if you use the historical data, historically, as you showed in the initial table, there seemed to be quite a difference in terms of the actual level between overpriced and underpriced. Mm-hmm. And anecdotally, that's not the case anymore, or definitely not as stronger because maybe of low vol effect over the last 10, 15 years, or I-vol effects. So I'm curious if the relationship that you suggest here, overpriced negative and underpriced positive, still holds if you control for that, for the actual level.
So you're worried about time variation in this effect being related to
so right now, let's say it's the opposite. It's actually high I-vol stocks that, low I-vol stocks that overpriced, and high I-vol stocks that underpriced currently, as opposed to history that was the opposite. Mm-hmm. So I'm just curious going forward with that.
Well, I can't answer that. We haven't looked at some last 10 years. We've split the sample up based on the sentiment, but that, of course, that includes some earlier and later periods. So yeah, I don't know the answer to that.
In your predictive regression results, even if you look at the most underpriced stocks, you still see the negative relationship between I-vol and returns. In the set of these regressions, you still see that highest I-vol actually tends to underperform compared to the lowest I-vol. Overall, it doesn't seem to be as strong as in the double sorts that you showed before. Mm-hmm. So I was wondering, do you have any intuition why it is like that?
Whenever you run a regression, I guess this would be my sort of general answer. Whenever you run a regression, you're imposing a functional form, which the portfolio sorting doesn't.
So you think the portfolio sorts would be sort of
in some sense, the portfolio sorting just looks for monotonicity.
Right, but it doesn't control for the value effects and size effects, and So
it is. Remember the portfolio sorts are looking at the returns on returns that are adjusted for these three factors, right? So the average returns you were seeing in those portfolios, the bars being plotted, were the returns adjusted for the exposures to market S&P and HML. Yeah. So it does control for them in exactly the same way we're doing it here.
Yeah, and I found it somewhat confusing that they're not aligned. Yeah, I mean, you would expect them to be aligned.
Sentiment has a negative effect on the difference between high and low, right? Which is what you'd expect.
Right.
Yeah. As to why this is a negative number, albeit an insignificant one, that I can't say. I mean, as I say, I might resort to a functional form explanation, but I don't have an explanation beyond that.
I think you nailed this thing. I mean, I'm convinced. When you go back to explain the mechanism behind the difficulty of shorting, I think you should look at the stock lending industry, both on the supply side and on demand side. I happen to have been on both sides in various capacities. From the demander's point of view, I did convertible arbitrage for a while. We did long the bond, short the stock. And of course, we wanted things where the you wanted to short the stock, so the price, it was overpriced as compared to the bond. And a lot of times everything would go well, and then there was something that you really wanted and you couldn't borrow. Or worse than that, there was something you really wanted, you borrowed it, you got it, you took your position. That's a little hard to do, getting both sides. And then the guy who lended it wants it back. And now you suddenly have to give it back, I think sort of like immediately, and you're stuck with one side and you're trying to unwind, and it's a mess. Okay, on the other hand, there's a limited supply of, there's a demand for the, one of the things that happens, the reason why you could borrow it and now you can't, you got to get it back, is all of a sudden lots of people decide it's also under. Now, there's only a limited supply of this stuff. Institutional investors are the ones that you typically.
Yeah, well, that's where the institutional ownership comes in. It
right,
has to do with both demand and supply. I
right,
think.
Demand and supply. And for, I was the president, I guess, of Japan Equity Fund, and we asked our investors, don't you want us to be able to borrow, lend stock? We got free money lending stock, and we couldn't get 51% of the stockholders to say yes, go. So there's the supply has limitations. I was also on something called ESEC, the advisory board of something called ESEC Lending, that was trying to institutionalize and automate the lending process. The supply and demand for lendable stock, which is needed to short, is complex, and it's an impediment, and it's the greatest impediment where everybody wants that same stock. You might look into that as the part of the mechanism for explaining this phenomenon yourself.
There is a challenge coming up with what we think are good proxies for this arbitrage, asymmetry, short sale impediments, and so forth. Yeah, maybe we can do better than the owner. Ownership seems to be something other people looked at and used. It's sort of comprehensive data over a relatively long time period. Other data we've tried to get is often limited in the time span, which for a study like this sort of limits its usefulness. But that's definitely something we are thinking about and should continue to. Andrew.
It's hard to deny that higher volatility, we have higher risk, and it's harder to put on arbitrages and trade, especially short positions. I'd like to ask a question, though, on the bigger picture. Mm-hmm. So we have a price that's presumably determined by some actions of investors, let's call it equilibrium. And then volatility is just a dynamic version of that over time, the series of different prices. Mm-hmm. And so they have to be endogenously determined, right? Both the so-called mispricing and the volatility, and I'm wondering if you can comment on that bigger picture.
So part of volatility isn't just inherent to information arrival, right? So are you asking why some stocks are more volatile than others?
If you want to interpret it that way, you're taking volatility as sort of like an X variable on the right-hand side to explain.
Yeah, I think we're treating volatility as exogenous here.
Exactly.
Yeah.
That's my question.
Okay, so you're saying, could we endogenize volatility? Part of volatility in a world where you think there are noise traders or some sort of mispricing forces, part of volatility can come from the presence of those folks in the market. So I suppose you could, in an equilibrium model, you could think about the dynamics of noise trader demand, how persistent it is, and so forth, and that would lead to some endogenous component of volatility. But I would think I think much of volatility comes from just, information arrival as information hits firms, prospects. Some firms are inherently riskier in the sense that their perceived value is more sensitive to new information than others. So I would think I would think an exogeneity assumption about volatility is not a bad first order. But yeah, you're right. In some sense, prices are equilibrium things, and if changes in those things are what lead to volatility, we should be able to sort of explain the volatility as well in some sense, at least it's partially endogenous. But I don't know how big the endogenous part would be relative to just sort of the native, primitive volatility that comes from the information arrival.
Earlier, you looked at some bond spreads, the difference between BAAs and AAAs, 30-day T-bills minus inflation, which is negative, has been for a while. How would you factor in an activist Federal Reserve that for 5 years seems to be actually targeting stock prices and looks like they're going to be doing it for the foreseeable future? How do you factor in something like that, or does it affect your analysis at all?
I certainly could. I mean, the ability of these yield spreads, for example, to predict stock returns could be itself a time-varying ability, even something that flips signs. I mean, there's a pretty large literature on the effects of these interest rate monetary variables on stock market returns. The degree of predictability that you get out of all those things is never big, at least in my reading that literature. You're looking at R-squareds of 0.0 something at an annual frequency typically. Maybe they climb to 0.1 something. Yeah, I mean, if there's some new sort of monetary policy indicator or variable that might predict the stock market better than these yield spreads, that's how you'd have to get it in there, I suppose. But I certainly plead ignorance on that at this point. We're just sort of following the use of some sort of standard interest rate spreads as market predictors, more or less as a robustness check. I mean, if we really thought there were serious time variation in equity premia due to that stuff, yeah, that's something we should probably think about. Again, you get to the basic problem, though, is to what extent do you want to interpret that as being related to sentiment, right? In other words, is it some rational risk premium one should be controlling for, or is it simply something that's going to help drive sentiment, and therefore if you control for it, you're just taking out, some sentiment effects, and you're just leaving, to leave behind only the sentiment you can't explain with anything else in the economy strikes me as potentially purging away a lot of the interesting sentiment variation. Last question.
Here. I actually two related questions. So, if I understand correctly, you explained the limits to arbitrage due to shorting as causing many of these effects, possibly all. So then two questions is, wouldn't then limits to arbitrage roughly on average make stocks overpriced and therefore fall in price?
Yeah.
That's true, but that doesn't seem to be empirically.
How do you know?
And the second question is...
How do you know stocks aren't overpriced on average?
That's not common lore.
I mean, the alphas the weighted average alpha has to be 0, but that doesn't mean that on average things are correctly priced. Everything can be overpriced, right? If the market's overpriced, how do you know it's not?
But you're looking at the subsequent returns. And my second question is sort of along the same lines. What if you used for subsequent returns a short interest, right? If there is a limit to that, and people want but couldn't short more, that means that the high short interest stocks will just fall down very quickly.
Well, the problem with short interest is it confounds the two effects of demand and supply, right?
But it's sort of
I mean, it's hard to know what to make of short interest in terms of how it should factor in here, I think. Thank you very much.